Chapter 3 is about the adjusting process. So far, what we've done in the accounting cycle is we've analyzed transactions, and then we produced a journal entry. We then take those journal entries and we post them to a ledger. That ledger then can be accumulated into an unadjusted trial balance. So far, in chapters 1 and 2, we've taken that unadjusted trial balance and we have created a set of financial statements. All right? The income statement, the retained earnings statement, and the balance sheet. That's what we've done for the first midterm. But that's not the whole process. Business transactions oftentimes involve an exchange of cash. Not always. Every once in a while you buy something on accounts payable on account and you earn revenue on account also. All right? And then you collect that. In order to get a full and complete picture of everything that has been earned during the month, there are 4 types of transactions. There are accruals and deferments. Deferrals. Accruals and deferrals. And those 2 main categories involve both revenues and expenses. The difference between an accrual and a deferral is an accrual cash has not changed hands. Whereas a deferral, cash has changed hands. I'll just say yes, cash. All right? So the adjusting process is going to lead to an adjusted trial balance. Well, just put TB there for trial balance. All right? The adjustment process involves 4 types of adjustments. You're going to either accrue a revenue or expense. All right? So something you've earned, but you haven't yet billed yet. Or something you owe, but you have not yet been billed for. Does that make sense? So accruals, there is no cash has changed hands. But yet, it's an expense that you have incurred in order to generate your revenues. Deferrals are cash has changed hands. your customer has paid you already, in which case you created a liability called unearned revenue. I used that example about airlines. When you book an airline ticket, you pay for it at the time you booked it. But the airline hasn't earned that ticket revenue yet because they haven't taken you to where you want to go. So that's a liability for them. So that's an example of a deferral. You've paid the airline. They've got their cash. Prepaid rent or prepaid insurance. An insurance policy that lasts for more than a month. Lasts for a year or 3 years. That's a deferred expense. You put it as an asset on the balance sheet. It's something you own in order to do your business. You own this insurance policy. But the insurance policy expires month after month after month. So an example of an adjustment that is needed for a deferred expense is to take that prepaid asset, insurance, and expense it. All right? Does this make sense? So there are 4 types of adjustments. An accrued revenue or an accrued expense, or a deferred revenue or a deferred expense. And I'm going to go over lots and lots and lots of examples out of the book. Okay? All right, let's get started. Let's start with problem 3-1A. 3-1A on page 139. On this one, it says on March 31st, 2016, the following data was accumulated to assist the accountant in preparing the adjusting entries for Potomac Realty. And there's A through E. All right? And we'll take them one at a time. Adjustment A. It says the supplies accounts, the balance on March 31st is $5,620. The supplies on hand on March 31st is $1,290. So let's just look at the T account. It has a balance of $5,620. Easy for me to write. All right? That's how much over the month you've been buying new supplies, and your total balance in that account at the end of the month in that ledger is $5,620. However, you went into the cabinet and you counted everything up, and it has a balance of $1,290. So you need to get from the unadjusted balance of $5,620 down to the adjusted balance, the supplies you have not yet used at the end of March, of $1,290. So how are you going to get there? You've got to lower that account, right? By $4,330. So how do you lower an asset account? Do you debit it or credit it? Credit. So you need to make a $4,330 adjustment Now here's the other secret about adjusting entries. Adjusting entries always affect at least one income statement account and one balance sheet account. One of each. So we know what the balance sheet account is. It's supplies. And we're going to credit that $4,330. That's the balance sheet account. What would be the income statement account? Makes perfect sense. What income statement account? It's an expense, so it's something expense. Supplies, of course. That's your journal entry. That is an example of a deferred expense because you've paid the cash for these supplies. There may be some invoices outstanding sitting in accounts payable, but you've paid the cash. All right? Cash is gone. But now you've expensed it because in the month of March you used up $4,330 worth of supplies because they're not in the cabinet anymore. Right? Now maybe a Post-it note went home in somebody's pocket, but you used it up. They're gone. So you need to reflect the expense with the revenue that was earned. We want to match. It's called the matching principle. We want to make sure that we match and we capture all of the expenses, whether we paid for them or not. Every expense in the period to reflect against the revenue that has been earned to properly calculate what net income is. All right? Does this make sense? Second one, B. The unearned rent account balance on March 31st is $5,000, representing the receipt of an advance payment on March 1 of 4 months' rent from tenants. So we have a liability account. Unearned rent. And unearned rent has a $5,000 balance. It's a liability, so it has a credit balance. So one of our tenants gave us 4 months' rent up front on the 1st of March. It's now the end of March. So we've now earned one of those 4 months. So we need to lower that liability because we don't owe the tenant that $5,000 anymore. Because they've occupied whatever it is they rented from us, office space or an apartment or whatever. So what's 1/5, 1/4 of this? Right? Half of it's $2,500, half of that is $1,250. That's how I do it. I'm sure there's other ways of figuring that out in your head. Okay? So we now know what the debit is. This is a deferred revenue. Cash changed hands back on the 1st of March when our tenant gave us the payment for 4 months' rent. So what's the credit? I'll give you a hint. It's something revenue. What would make sense in this case? Income, maybe. There's a better word. What is it? Huh? Rent. It's rent revenue, yes. Because we're a realty company, so we may have commission revenue from when we sell houses. We may have all sorts of revenue. We have maintenance revenue. We may have a crew of maintenance people that go around and fix houses. That's a deferred revenue. So we have a deferred expense and a deferred revenue. Cash has changed hands already, but we now need to either earn the revenue or expense the deferred expense in order to match and properly reflect, because this is March revenue. We've earned that rent in the month of March. Okay? Everybody good? C, wages accrued but not paid at March 31st are $2,290. This is an accrued expense. Our employees have earned that money. Most employers pay on a biweekly basis. Every other Friday, as they say in the construction, the eagle flies on Friday, payday. Go to the bank, get your cash, go spend it. Right? It's a beautiful thing. But the months don't always end on Friday. The month may have ended on Wednesday or Thursday, but you're not going to actually give them their cash until the next day. But they've earned their money, working for you, generating your revenue. So you need to get those wages, unpaid wages, into the month of March. Right? So the income statement account is wages. I'm sorry. Yeah. $2,290. That's the income statement account. What's the balance sheet account? What would be the credit? How are we paying them? Are we paying them on March 31st? No. We're not paying them until April 1st or 2nd or 3rd, the Friday we pay them. It's something payable. Wages payable. Accounts payable is trade accounts between you and your vendors or your suppliers or contractors, people that work for you. Your actual employees are wages payable. Okay? Bless you. D, fees accrued but unbilled on March 31st are $16,825. So we've earned this money. We haven't been paid. We probably haven't even sent the bill out yet. But we've earned it. So we need to get it into the March income statement. So let's start with the balance sheet account. So if somebody owes us money from our earnings, our hard work, but they haven't paid us yet, what do we call that? Accounts receivable. So we've earned it. Fees earned. Could be commissions earned or, real estate company. We could have sold a house on the last day of the month. We're done. We've sold the house, but we haven't received our cash yet from the title company. Normally takes a couple of days for escrow to clear. All right? But we've earned it. We need to put it in the month of March. That's an accrued revenue. An accrued expense and an accrued revenue. So we've now done all four types. We've done a deferred revenue, we've done a deferred expense, we've done an accrued expense, and an accrued revenue now. That's all four types of expenses, of adjusting expense entries. And the very last one, depreciation of office equipment, is $4,600. So depreciation is a systematic, and we'll get into a lot of detail on this in a later chapter, is a systematic expensing of a long-term tangible asset, something you can touch. All right? Office equipment, computer equipment, furniture and fixtures, buildings, airplanes, boats, trains, automobiles, trucks. Tangible, something you can touch. All right? And we'll get into how you depreciate long-term assets in a later chapter. But we've determined depreciation expense $4,600. That's the income statement account. Now this one's a little tricky. The balance sheet account goes to something called a contra asset account. Contra asset. It's a negative asset. It's an opposite. Contra is just opposite. If somebody's being contrary with you, they're arguing with you. I'm sure you've never had that, right? People always go, yep, I agree with you totally. So if they're arguing with you, they're being contrary. So a contra asset account is negative. And in this case, we call it accumulated depreciation. And so it doesn't really say, oh, it's office equipment. So you'd have on your balance sheet an asset called office equipment. You would leave that alone. That is the historical cost of that equipment. And then underneath it on the balance sheet, which next week when we get to our classified balance sheet, our reporting balance sheet, I'll show you how to display that. So you would then subtract all of the depreciation you've taken on that class of asset, whether it's office equipment or office buildings or warehouses or airliners or whatever it is you own, and you subtract that. You subtract that negative asset account, that contra asset account. Okay? See, that wasn't so painful. Let's do another one because this is fun. Number 2. Says a selected account balances before adjustment for Atlantic Coast Realty, another realty company, on July 31st, 2016, the end of the current year are as follows. And they've got A through F. So this is number 2. It starts on page 139 and it continues on page 140. The first one, unbilled fees at July 31st are $11,150. This is a deferred revenue. So we've already talked about this. The debit is to accounts receivable. And the credit is to fees earned. $11,150. Supplies on hand on July 31st, $900. And if you look at this unadjusted trial balance that's at the top of page 140, you'll see that the supplies account has an unadjusted balance of $3,350. So we've done this one already too. Supplies, expense, and then we're going to credit supplies. So we have a balance of $3,350, but yet on hand we only have $900. So if you subtract that, you get $2,450. Rent expired, $6,000. Look once again at the unadjusted trial balance and you see there's a prepaid rent expense that has a $9,000 balance in it. So here's a deferred expense. We paid the rent in advance, gave them a check. So we now need to expense the rent that has expired. We've occupied the facility. So that's going to be rent expense. And that's the income statement account, and prepaid rent for $6,000. Depreciation of equipment during the year, $8,950. We've done this one before. $8,950. So who remembers what the balance sheet account is? That contra asset account accumulated and this is on equipment. Unearned fees at July 31st, $2,000. Unearned fees at July 31st, $2,000. So you need to look on the balance sheet, the unadjusted trial balance again, And you'll see there's a liability account called unearned fees that has a balance in it of $12,000. So only $2,000 of that is still unearned. You still haven't completed the earnings process for that $2,000 at the end of July. So this, you're going to lower that liability. By $10,000, because you have $12,000 in the account. The ledger balance at the end of July is $12,000. The only portion of that $12,000 that is still unearned is $2,000. So the rest of it you've earned, fees earned. All right? And the last one, wages accrued but not yet paid, $4,840. F. Wages expense, and wages payable. $4,840. To accrue the expenses. All right, I'm not going to do all of 3A. I'm just going to do one entry in there because they word it a little differently so that you know what. So 3A on page 141 now. That's 140 and 141. And I'm going to do entry number D. On D, it says the balance in unearned fees represented the April 1 receipt in advance for services to be provided. So if you look, there is unearned fees of $10,000. During April, I'm sorry, it's got to be more than that. 18,000, I read the wrong one. There's in unearned fees. There's an 18,000 on April the 1st. There was an entry for that. So the debit would have been to cash. Somebody paid us in cash $18,000, and we credited the liability. It says during April, 15,000 of the services, because this one now is reliable repair and service. So this is a repair shop that's apparently very reliable. Come on, that was funny. we've repaired or rendered services for $15,000 worth of that down payment. All right? So the D adjustment, and that leaves us a balance at the end of April for $3,000 yet to be served. So this is unearned. The debit is to the balance sheet. And fees earned. For $15,000. All right, I'm going to do one last comprehensive one, and then I'm going to show you what you can do with it after you're finished. So the last one I'm going to do is 3-5A, and it's on page 142. And then on this one, it's Roland Company is a small editorial service. I don't know what that is. Owned and operated by Matthew Roland. On August the 31st, the end of the current year, their accounting clerk prepared the following unadjusted trial balance. So it lists all the asset, liabilities, stockholders' equity, as well as the revenues, which are fees earned, once again, and 4 types of expenses: salaries and wages, utilities, advertising, repairs, and miscellaneous. The data needed to determine year-end adjustments are as followed. So A, unexpired insurance at August 31st is $6,000. So if you look down that list, you'll see prepaid insurance had a balance of $7,200. At the end of the year, at the end of August, $6,000 of that was still unexpired. It's insurance policies that extend beyond the year end, whether they're 1, 2, 3, or 50-year policies. Okay? So if you have a balance in there of $7,200, $6,000 of which is unexpired, how much do you need to expense? $7,200 minus $6,000 is, carry the 1, divide, yes, $1,200. We know we have to lower the asset account because that portion of the prepaid insurance is expired. So the credit is the prepaid insurance. That's the balance sheet account. The debit, therefore, has to be an expense account. So something expense. Insurance. That's a deferred expense. We paid the cash when we bought the policies. Now a portion of those policies have expired. We need to get the insurance expense, the coverage for insurance, back into the period where we earned the revenue that those insurance policies protected us for. Supplies on hand on August 31st. $480. We've done this one. Supplies expense. And the asset. This is another deferred expense. So if the supplies account has a balance of $1,980, we have $480 on hand, still in the supplies cabinet. Now, in reality, there's not a business out there that goes and counts their supplies cabinet. Nobody. We don't torture accountants that much. You just expense it normally, but it's a good example. Maybe you're dealing with some very, very expensive supplies. I don't know. All right, so the difference is $1,500. Depreciation on the building for the year, $7,500. So depreciation expense for the building is $7,500. That's the income statement account. Another type of deferred expense. We paid the cash when we built the building. The balance sheet account is that strange little contra asset. Accumulated depreciation. For building. Depreciation on the equipment for the year. $4,150. So this is the same entry, deferred expense. Depreciation expense. Equipment, $4,150. Accumulated depreciation, on that same equipment is $4,150. Rent, unearned at August 31st, $1,550. So you look at the unadjusted trial balance, there in the liability section, right underneath accounts payable, is an unearned rent liability. So somebody is paying us in advance to rent. And that balance is $6,750. The unearned, still unearned portion of that is $1,550. E. You need to lower the liability. This is a deferred revenue. And we now need to get it onto the income statement in the form of rent revenue. Accrued salaries and wages at August 31st. $3,200. So this is salaries and wages expense. And salaries and wages payable. So the income statement account and the balance sheet account, $3,200. The very last adjustment needed at year end are fees earned but unbilled on August 31st, $11,330. So the balance sheet account is accounts receivable. Where? This one? Salaries and wages expense. And fees earned. $11,300. So what you can do now, yeah. It did. That's all right.